inflation seems to be a major concern. For both the retired and pre-retired, according to the study, 78% of pre-retiree respondents expressed concern over inflation's effect on their retirement income. 58% of retirees reported concern over the same issue. These numbers make sense when you look at how inflation has impacted common expenses. 51% of pre-retirees and 35% of retirees reported rising costs of food and daily expenses. 45% of pre-retirees and 29% of retirees reported rising utility bills. And finally, 44% of pre-retirees and 27% of retirees said lifestyle costs had gone up. So this is a really important issue that I talk about a lot with a lot of people, and hopefully it provides value to you as well. Inflation is arguably the number one risk to your retirement success outside of health, right? So whether we are alive or pass away early, that kind of trumps all, and significant health events can absolutely destroy our money. But assuming you are able to live a long, relatively healthy and enjoyable retirement, inflation is arguably the largest risk to retirement because of the increased cost of living. Good morning, everyone. It is Thursday, January 9th, and I hope everyone's having a wonderful day, and I appreciate everyone that is willing to take the time to join me live today for this retirement planning coffee talk, as well as take the time to watch it at a later date. As always, please take the time to comment with any questions, thoughts, or concerns that you have, or reach out directly with questions that you have today or things you'd like me to discuss in the future. With that being said, like I said, welcome to the January 9th Retirement Planning Coffee Talk. Retirement Planning Coffee Talks are a casual way for me to connect and answer questions, even if you are not a client, at no cost. Join us on Facebook Live, where we are right now, live, or stop by my office to enjoy some free coffee. It is at the Freaky Plaza upstairs. The door is closed to try to reduce noise for people walking by, but if you're here for the Retirement Planning Coffee Talk, feel free to just knock and come on in and enjoy some coffee. If you'd rather not ask questions online or in person during the live session, feel free to message me directly or simply enjoy your coffee at my office and we can chat once the live video wraps up. There is absolutely no pressure to work with me or become a client, whether you join in person or online. My mission is to provide my clients with the highest quality advice and service possible. To maintain this level of care, I limit my practice to 100 active clients at all time, as I have a fiduciary responsibility to each and every one of them. While I cap the number of clients I work with, I am dedicated to serving as many people as possible by sharing valuable information and answering your questions. That's why these coffee talks mean so much to me. I'm looking forward to some great conversations and hope you have a wonderful day either way. Please feel free to comment with questions anytime, now or during the video. I'd much rather answer your questions than read through articles that may or may not be relevant to you. I included in the comments or included in the description of this video is the link to my calendar if you'd like to schedule a call to ask questions privately. And disclaimer, this content is not legal, tax, or investment advice. Always consult a qualified professional regarding your own situation. And since this is a live session, I may occasionally make a mistake, but I'll do my best not to. Thank you so much again for joining me today. I look forward to answering your questions and hopefully providing a lot of value. In order to do so, though, like I said, the more questions or comments, the better. While I wait for questions and comments, I don't see any yet, so I'll jump into an article that I pulled up here. Also, kind of rare, but it's for the first time that I'm aware of. The stock market is actually closed today in remembrance of Jimmy Carter's passing. I believe it was last week. So it's an interesting bit of news. It caught me off guard a little bit to see the markets closed today, but they are closed. So with that being said, I will jump into the first article that I hope provides value and prompts some questions from the audience. And the article is titled "Inflation and Family Caregiving Squeeze Retirement Plans," and it is on benefitspro.com. I will copy and paste it into the comment section in case you'd like to follow along or read it at a later time on your own. All right, so it's written by Henry Craver. And it says, according to the study, 78% of pre-retiree respondents expressed concern over inflation's effect on their retirement income. That's a big number. A number of different factors are putting stress on the finances of retired and pre-retiree Americans. According to a new report from the Society of Actuaries Research Institute, retirees are less likely to report being better off than expected in 2024 than in 2021. The study also shows that pre-retirees are more conscious of unplanned financial events than before. The most recent biennial retirement risk survey, which surveyed 2012 Americans aged 45 to 80, points to a number of factors changing retiree and pre-retiree expectations and savings plans. Inflation seems to be a major concern. For both the retired and pre-retired, according to the study, 78% of pre-retiree respondents expressed concern over inflation's effect on their retirement income. 58% of retirees reported concern over the same issue. These numbers make sense when you look at how inflation has impacted common expenses. 51% of pre-retirees and 35% of retirees reported rising costs of food and daily expenses. 45% of pre-retirees and 29% of retirees reported rising utility bills. And finally, 44% of pre-retirees and 27% of retirees said lifestyle costs had gone up. So this is a really, really, really important issue that I talk about a lot with a lot of people, and hopefully it provides value to you as well. Inflation is arguably the number one risk to your retirement success outside of health, right? So whether we are alive or pass away early, that kind of trumps all, and significant health events can absolutely destroy our money. But assuming you are able to live a long, relatively healthy and enjoyable retirement, inflation is arguably the largest risk to retirement because of the increased cost of living. Each and every year, what we did this year will cost to do the same thing next year. So when it comes to living in a long time in retirement, we can't just maintain our income to maintain our lifestyle. We actually have to increase our income to maintain our lifestyle. And just putting some easy numbers together, if historically inflation's been about 3% per year, now if we use the rule 72, that says that every 24 years, life will cost twice as much as it did this year. So it's 2025. That means in 2049, living the exact same lifestyle today will cost twice as much in 2049. That's at 3% inflation. Now, if you rewind back to 2021, 2022, why many people are struggling today with costs of living is not because of inflation in the last 12 months, but because of the high inflation the years before that, where inflation was like 8%. Now, if inflation was 8% a year every year, which it typically isn't, and that's why the Fed messes with interest rates to try to manipulate that. But if it was, if inflate at 8%, life gets twice as expensive every 9 years. So it's 2025. If inflation was 8% every year for the next 9 years, in 2034, life would be twice as expensive as it is today to do the exact same things, right? Think of everything you do this year costing twice as much in 9 years. So what's that? Where does that put pressure? It puts pressure on our retirement planning, in our income strategies, in our portfolio growth, because we have to double your income if you want to maintain your lifestyle, right? Or we have to increase your income to maintain your lifestyle. And inflation has a big part of that. Unless you want to just decrease your lifestyle throughout retirement, but most people I talk to, that's not the goal. So back to the article, beyond rising prices, a significant number of pre-retirees and retirees have taken major financial hits. Specifically, 20% of retirees, 20% of retirees and 35% of pre-retirees reported financial shocks that resulted in a loss of more than 25% of their assets. That's a big number. And that will only further compound the pressure or the challenges of dealing with inflation. Family and caregiving issues might also affect the finances of pre-retirees and retirees. 13% of pre-retiree respondents reported having given care to family members who are not their own minor children. So that would be parents, adult offspring, grandchildren, extended family, and etc. What's more, less than 10% of both retirees and pre-retirees said they provide significant financial support to family members. 38% of pre-retirees and 27% of retirees felt unprepared to handle a family member's medical emergency or health issue. So that's a lot of numbers and percentages, but basically what they're saying is having to help a family member can also add a lot of financial stress to your retirement. Anna Rappaport, FSA, MAAA, past OSA president and current chair of the SOA Committee on Post-Retirement Needs and Risks, expressed worry over the challenges related to family and caregiving, saying, I'm concerned respondents might be overestimating their level of preparedness. The costs and caregiving obligations connected to a medical emergency or health issue can be very high. Even though inflation rates have come down, many are still affected by high prices for housing and groceries. So, a lot of times, what we see in a retirement is what we call the retirement smile. So, early in retirement, we spend more because we're younger, healthier, and active. And then in the middle of retirement, we might spend a little bit less, but keep in mind inflation's happening, so it doesn't mean you need less income. And then later in retirement, we end up spending more again because of health costs, emergency costs, things like that. As we age, the chances that something medically happens increase. All right, so that's an interesting point being made. I think every year inflation is important, but especially this year, I feel like the last 12 months, even though inflation's only been about 2.7%, people are talking about it a lot more because of the high rates before the last 12 months. So that's an interesting part around retirement planning. If you have any questions or comments on inflation and how it might affect your retirement or anything else retirement planning, please put it in the comments section now, and I would love to have that discussion. All right, seeing no questions, I will open up another article here that hopefully provides you value, and I will put it in the comments section. It is titled Market Review 2024, Stocks Overcome Uncertainty to Notch Another Strong Year, and it is written by dimensional.com. More specifically, the author is, oh, it must be a group of authors because I don't see a name on here. So dimensional.com is where it's written, and I will put it in the comments section now in case you'd like to follow along or check it out at a later time on your own. I do pay for a Dimensional subscription, so if you'd like a copy emailed to you, just let me know and I'm happy to send you one. So with that being said, the key takeaways we'll cover here in this article are, and again, at any time, leave a comment. I'd happily step away from this article and address your specific questions. The key takeaways from this article are U.S. stocks extended a bull market, with the S&P 500 gaining 25% in 2024, its second year in a row with gains of more than 20%. The Fed lowered interest rates, but the 10-year U.S. Treasury yield moved in the opposite direction. Value stocks lagged growth in stocks in the U.S. and globally, but fared better in the non-U.S. markets. Financial markets showed resilience in 2024, extending the bull market that began in late 2022 as stocks weathered interest rate changes, uncertainty around the U.S. elections, and the ups and downs of the Magnificent Seven stocks. The S&P 500 posted a gain of more than 20% for the second year in a row, for the first time that has happened since 1998-1999. While there were some notable downturns through the year, they were followed by quick recoveries. So that's really valuable information to understand that, as we discussed in our last article, inflation on average is about 3%. So if this S&P 500 was up 20% last year, or your portfolio was up 20% last year, that means your portfolio outgrew the market by about 17%, right? 20 minus 3. However, if you didn't have your money in the stock market and you had it sitting in cash, your money lost buying power to inflation. So it's really important to balance out the risk of market volatility versus the risk of inflation long term in your retirement. And also, it's important to understand that 1 out of 4 market years are going to be likely negative based on historical averages. So even though the last 2 years, the U.S. market's been up about 20% each of the years, that's pretty rare. The last time it happened was 1998, 1999, and it should not be expected every year. It's funny how sometimes we get our expectations to become unrealistic based on recent history. Historically speaking, the long-term average of the U.S. market is and the S&P 500 is about 10% a year, not 20. All right, so let's keep that in mind. 1 out of 4 years are historically negative, and on average, the market only goes up about 10% a year, not 20% every year. So advances in the U.S. and other developed markets led to positive returns globally. There's an exhibit here if you want to check it out. I'll just highlight it briefly. Although emerging markets lagged developed markets, in the fall, the U.S. Federal Reserve cut interest rates by 0.5 point, which preceded to 2 subsequent quarter-point cuts. Overall, U.S. bond prices rose for the year, but the U.S. Treasury prices were mixed. The benchmark 10-year fell, pushing its yield above 4.5%. So some people, out of safety or being a fear of market volatility, will put their money in U.S. Treasury bonds or in things like that, and those fell. The 10-year U.S. Treasury fell to 4.5%. So again, using that inflation number, if inflation is 3% and you get 4.5%, you're outgrowing it by 1.5. But if you put your money in U.S. Treasury getting 4.5% and the inflation's 8%, you're still losing purchasing power, even though it feels like your portfolio is increasing a little bit. So sometimes it's funny how sometimes I hear people say, "I just want some growth," but it's more important to understand the net growth of your portfolio compared to inflation, not just accepting any and all growth. 1% growth is not actually growth when you consider the costs of inflation. All right. Keep in mind, past performance is not a guarantee of future results. The Fed lowered the federal funds rate to the 4.2 to 4.5% range after 3 rate cuts totaling a full percentage point in September, November, and December. The reductions, which were the first since the COVID-19 pandemic in March 2020, came amid easing inflation, conflicting readings on the job market. Inflation remained near multi-year lows, with the November Core Consumer Price Index, which excludes more volatile food and energy items, showing prices rose 3.3% from a year earlier. So excluding food, it's 3.3%. I would be really curious to know what it was including food, because I feel like a lot of people are struggling to afford food right now. Whether it's restaurants having to increase costs to make sure they make money, so less people are eating out, or going to the grocery store and having 3 grocery bags equal $100 when it used to be maybe feel like 60. It just feels like food is a really hot topic of cost right now in the circles that I'm in, with people talking about things that are affecting their ability to live the lifestyle they want to live. Back to the article. While investors may worry about the impact of interest rate changes, it's helpful to remember that the market and the Fed do not necessarily travel in lockstep. In months since 1983, when the Fed has cut or hiked rates, the 10-year Treasury yield has moved in the same direction as the federal funds rate nearly 2/3 of the time, which means the 10-year moved in the opposite direction around 1/3 of the time. Nor have stocks seemed to take their direction from policymakers at the Federal Reserve. Over that same period, the average U.S. stock market return was similar in months with target rate increases, decreases, and no change. It's a reminder that the market is constantly incorporating new information into prices, including expectations for moves by the Fed. This is really important, so I'm going to repeat it. So often, people take what they hear in the news and try to apply it to short-term planning, without understanding that the big companies are always trying to make money. They don't just stop trying because the markets are tough. And they also have already likely forecasted what you are hearing today. So reacting to what you hear today, it's already been probably baked into the market prices a while ago. All right? So again, the article says, it's a reminder that the market is constantly incorporating new information into prices, including expectations for moves by the Fed. Another strong reminder that we should never make long-term financial planning decisions based on short-term financial events or the news, unless it affects your goals and life situation drastically, right? So we should make financial planning decisions based on your life, not the news and short-term events. All right, so the U.S. elections concluded with Republicans winning the presidency as well as control of the Senate and House of Representatives. Election outcomes aside, history shows stocks have trended higher regardless of which party is in power in Washington. And while uncertainty about what comes next, investors wondering about the post-election world can remember that markets have moved forward even in difficult times like 2020. The message is that whether you are optimistic or pessimistic about the future, there's reason for optimism about the market. Market prices continually reset to offer investors positive expected returns. This one is so hard for people to understand or accept oftentimes, because whether you voted Republican or Democrat, you're either really happy or really upset with the outcome, possibly. That doesn't mean the market feels the same way. The market is about numbers, and again, the companies that are in this country and around the world, regardless of who's in the office, still try to make money. They still want to drive profits. They still want to grow. All right. Gains around the globe. Amid this economic and political backdrop, U.S. stocks posted strong returns. With the S&P 500 index rising 25%, technology companies including Nvidia and other artificial intelligence related stocks led the market higher. Despite some sell-offs late in the year, the tech-heavy Nasdaq gained 29.6%, helped largely by the US global stock markets reached multi-year peaks in 2024. Equities, as measured by the MSCI All Country World Index, rose 17.5% even as geopolitical tensions remained high. With war continuing in Ukraine and unrest spreading in the Middle East, including the collapse of Syria's ruling regime in December, developed international stocks lagged the United States, with the MSCI World X US index adding just 4.7%. Emerging markets fared slightly better, with the MSCI Emerging Markets Index of 7.5%. So what does that mean? In the last 12 months, the S&P 500 index was up 25%, where the MSCI World X US index, which basically just says the world minus the US, was only up 4.7%, and emerging markets was up 7.5%. So, if 12 months ago you could see into a crystal ball and know what was going to happen, the US market was the place to be. But we have to remember, we can't predict the future. No one can. And historical results do not guarantee future results. So just because that's what happened in the last 12 months, that doesn't mean that's what's going to happen in the next 12 months, which is why we always invest with our clients in a world diversified way. We never want all of our money in one basket, and that includes one government or one nation. Because the last 10 years, the U.S. market's been doing phenomenal. From 2010 to 2020, the U.S. market was virtually flat. And we don't ever want flat because inflation doesn't stop, right? So the bond market was mixed. The U.S. prices rising slightly overall, as measured by the Bloomberg U.S. Aggregate Bond Index, which gained 1.3% in 2024, but the 10-year U.S. Treasury declined for the year, sending its benchmark yield up to 4.58%. As the 10-year yield rose above the 2-year, the yield flattened, and they keep on going with that. The main thing I'm going to say about bonds is this. When you invest in stocks, you own a very small percentage of those companies. You are an owner, not a loaner. You're an owner. And typically, owning something generates more value and more growth and more revenue than anything else, typically. It comes with a little more risk, right? The stock market might have a little more up and down than the bond market, but the ups are going to be a lot more up, and the downs might be a little more down. But with dividends being reinvested, and if you're still saving, dollar cost averaging is going to create more long-term return. And historically speaking, the U.S. market has averaged about 10% return, whereas the U.S. bonds have averaged about 5%. That's literally twice, which in 1 year seems big, but compounded over a long period of time, it's huge, the difference in value of that. So keep in mind, when you invest in bonds, you're no longer owning, you're loaning your money. And though that works great for banks in our country to loan money and make tons of money off of it, they're doing it in a much larger scale, right? So keep in mind that it's not all, there has to be a specific purpose for owning bonds over stocks rather than just being terrified of volatility. All right, so with that, they talk about premium performance and eyes on the new year. I feel like we've talked enough about numbers and the past. The biggest thing I think we can take away from all this today is inflation affects planning, whether you like it or not. So plan for it to be there rather than just avoiding it. But understand that your net growth above inflation is the key to long-term planning. And then U.S. stocks extended a bull market last year and had 20% gain for the 2 years in a row, but that's rare. Don't expect it moving forward. We'll hope for it, but don't expect it. The Fed lowered interest rates last year, and value stocks lagged growth stocks in the U.S. and globally, but fared better in non-U.S. markets. So with that being said, I didn't get any questions today, but hopefully the conversation that we talked about was valuable for you. I strongly encourage you to take the time to reach out to someone that you currently trust or that you could see, potentially trusting down the road to build your financial plan, and make sure that when you're building your retirement plan, you're incorporating inflation, market volatility, and diversification worldwide between equities and maybe in some bonds, depending on where you're at in your retirement journey or planning journey. And if you have questions or don't have someone you already trust, I'd be more than happy to have a conversation. The link to schedule a 15-minute call is in the description of this live video, as well as can be found on the event information for this. So with that being said, if you have any last questions, comments, or concerns, please put them in the comments now. Otherwise, I will encourage you to enjoy the rest of your day and wish you great health and wealth in the future. Thanks so much for your time. Please take the time, if you enjoyed this conversation, to share it with a friend, share it on your social media, comment with questions or thoughts or requests for future conversations, and at the very least, click the like button so that hopefully Facebook will show the video to more people and I can provide more value for free. Thank you so much for your time and I hope you have a great day. Bye.